It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today: to hike or hold. It's decision day at the ECB. Bloomberg is live in Frankfurt as the cliffhanger looms. A NASDAQ debut for the largest listing of the year. ARM priced its IPO at the top end of the range, and now the stock starts trading today. And more drama at Goldman Sachs. The bank abruptly fires executives at a unit it's been working hard to grow. Good morning and welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London with Sonja Marten in New York. Sonja, this isn't an I told you so, but I did say yesterday that the ECB would be more exciting than the CPI. And the CPI, I mean, the reaction, we got to admit, was a little bit of a snoozer.
I wish I was there to buy you a drink one time after the show, Danny. You have been talking about you winning this bet all week. I do want to talk about S&P futures, though, because it is a beautiful day here in the United States for an IPO. You are looking at the S&P 500 futures up 0.2%. Remember, volatility is also quite low. We are below the one-year average on the VIX, and so the S&P is looking green, but again, a lot can happen in a morning. We will watch for that ARM IPO to start trading. It will mean a lot for investor sentiment into new stock. Now, the two-year yield, 498. Now that looks low relative to what we've seen earlier in the week. I do want to talk about the volatility we've seen here, even with a 1 basis point move in the two-year yield. The amazing thing here, Danny, with the two-year is that it has moved intraday over the course of 3 days, 12 basis points from a range of 495 to 507. So we will keep an eye on that throughout the day. The U.S. dollar finally getting some relief. We have known that that has been hot for the last week or so. Brent crude at a 92 handle. I would also point out that WTI is flirting with 90. This move in oil, 7 basis points higher, or 0.7% higher, in Brent crude. We will talk about that oil story more on the show today.
Yeah, we definitely will, and how it relates to inflation. Sonali, I should say, or at least to our viewers, my bet is not with Sonali. It is with producer Dan Curtis. I said a week ago that the ECB would hike today. Back then, we were pricing just a 33% chance that they would hike. So even if I'm wrong, the market has moved in my direction. I'm pretty pleased with myself about that. Even so, it's remarkable to look at a euro that hasn't really moved much as this market has kind of gotten hawked up. Euro versus the dollar still at 107, barely moved today. Not a lot of stuff is moving today. We got to wait for that ECB decision. Two-year yields, those not moving either at the moment in Germany. Again, we're pricing above a 60% odd that they will indeed hike today. But economists surveyed by Bloomberg, the majority of those do believe that they will hold. We'll talk to Kallum Pickering later in the show, who also believes that it's weighted towards a hold today. Finally, European stocks really just being supported by basic materials and energy because of what you pointed out, Sonali, those higher oil prices. But on a headline basis, barely moved to slightly higher.
Now we've been talking about it. It's that knife's edge decision today from the European Central Bank on whether to raise interest rates for a 10th straight time or to pause. Bloomberg's Maria Tadeo is standing by at the ECB in Frankfurt. Maria, hike or hold?
Hike or hold? That's a very good question, but I also like to say, Danny, yes, she agreed it was a hike a week ago, but I also sent her an IB. I remember this very well, saying, I don't get it. I don't understand why the market believes they're going for a hold. And again, this takes us now to this decision where the market sentiment, once again, it has been a roller coaster 3 weeks, actually, in terms of pricing, now is positioned for a hike today. We should note, and the context here really matters, is that today we get a monetary policy decision, but we also get new economic projections, including inflation. And this change in sentiment has been precipitated by that Reuters story, then confirmed by Bloomberg, which says or predicts that in the new forecast, the European Central Bank will still see inflation above 3% in 2024. And the reason why 2024 matters is because that was seen as the key year, as a crucial year in terms of transmission. Remember, the whole decision hinges around the idea of transmission being effective, being operation. There is a lag. We know, obviously, that happens with monetary policy. But if you believe that transmission had done its job, then you could argue there was a hold. Having said that, if you look at inflation and it doesn't transmit, or it doesn't reflect that strength in the transmission, there was still a case for a rate hike. And that takes us to today, the market position for a new hike from the European Central Bank. 10th consecutive should take deposit rate to 4% and leave Madame Lagarde with a complicated communications exercise in that press conference.
Yeah, and Maria, we should also know you have really been questioning the consensus of a hold, and now it's no longer consensus. You were out in front on this.
I did.
Now, yeah, it's true. Maria gets a victory lap today. Now, beyond the monetary policy decision, the ECB really is facing an increasingly difficult outlook. As you've been laying out, how difficult will it be for them to avoid a policy error?
Yes, and look, the ghost of a policy error, perhaps of the past, permeating in this building. Look, whatever happens today, whether it's a hold or a hike, and again, we should notice we say that the market is positioned for a hike. There will be pushback as to what led to that rationale, because when you look at the data, you could argue both things. This is a single mandate central bank. Of course, if you see inflation above 3% also heading into next year, then that would merit a hike. But you also have to factor that obviously there is an economic context, and in those same projections, you could get a downgrade to GDP growth. Remember, the European Commission at the start of the week already downgraded the GDP expectations for this year and next. There is a palpable decline in the European economy. And it's not just Germany, it's not just manufacturing. When you look at the indicators that we've had over the past 6 weeks, they point to widespread concerns and weakness, not just, again, in the biggest economy, but really spreading across the euro area. Nonetheless, if you go back to the hike, it is a single mandate central bank. And of course, they always said they would look into that data point, and they would look also into the dynamics that would certify and make it clear that inflation is going down sustainably to that 2% target. It is a challenging communications exercise for the head of the ECB. Again, if you assume they hike today, they would be hiking into a downturn. Again, that's a difficult scenario for any central bank, and it is a scenario the ECB said they wanted to avoid when they started hiking.
All right, Maria, we're going to let you go. You got 3 hours to prepare for the big decision. Maria Tadeo there reporting live from Frankfurt at the ECB. And stay with us with Bloomberg for the full coverage of that decision. Again, 8:15 a.m. Eastern time is when it's going to hit. All right, the other big event today. It is ARM's NASDAQ debut. It priced the IPO at the top end of its range to raise nearly $5 billion in the latest listing of this year. Joining us now is Bloomberg Deals reporter Sweta Gopinath. Sweta, what details do we know about this IPO so far? When it's going to list today? What are we looking out for?
It's a record-setting deal, really, and it's a big moment for global equity capital markets, which have been depressed for a good 2 years almost now. This is the deal that we've all been watching, and today is the big day, of course. They're priced at the top end of the range. It's valued at about $54.5 billion. It's the largest listing globally this year. It's the largest U.S. listing since 2021. So it just tells you about the state of the market. We haven't had deals of this size come through. And this could very well sort of open the floodgates for other tech listings, if it goes successfully, of course.
I guess I'm a little skeptical. There's a sense here that this can reopen the IPO markets at a greater scale. However, the reality is we're sitting here in the middle of September. The window for IPOs is very small. If you're going to list, you really need to file pretty soon. So how significant is the ARM IPO for the broader equity capital markets, or is it a standalone?
It's not, I mean, it's a standalone in the sense that we don't really have deals of that size, globally speaking, right now. But in the US, we've seen at least 3 other S1 filings over the last couple of weeks. We have Instacart, we have Klaviyo, we have Birkenstock, all looking to list. So it's sort of the green shoot of a rebound, and I think it's most pronounced in the US, really. We're not seeing any of that here in Europe. In Europe, it's pretty much still a very depressed market, and Birkenstock going to the US, that's actually another loss for the European market, coming just on the back of ARM's big loss to London.
So here's my fun fact of the day. Sonali Basak wore Birkenstocks into the office today. That's how committed she is to the IPO market. And we've now decided that that's her permanent outfit for IPO day. Sorry, Sonali, you're stuck with it.
I'm all about it. I think it's a really good ritual, actually. It's better for your feet, too.
Yeah, everyone please write in and petition for Sonali to also wear them on air. Hey, Sweta, thank you so much for joining us. Bloomberg Sweta Gopinath there on the ARM IPO. All right, let's turn to banking now. Goldman Sachs has fired transaction banking executives, including the head of the business, Harry Morty, over compliance lapses. The abrupt ousters hit a unit that the firm has been working hard to grow. Joining us now on that is Bloomberg finance reporter Will Shaw. Will, what happened here, and what is the wider context for this business unit?
Yeah, so Harry Morty's career with Goldman Sachs is effectively over. He was fired for unauthorized communications on unauthorized channels and failing to cooperate with an internal probe. He was fired along with several of his colleagues. It's a big blow for that part of the business, which, like you say, Goldman Sachs have been keen to grow. In fact, the chief executive, David Solomon, singled it out in February, saying effectively it was at the beginning of its potential to deliver more for the bank. Ultimately, Wall Street banks just can't take a risk on things like WhatsApp communications anymore. Last year, US regulators reached a settlement with about 12 banks that included Goldman Sachs for failure to monitor these kind of communications. And that took the total penalties for this kind of conduct to over $2 billion. So nobody is taking any risks on this kind of thing at the moment.
I want to switch gears and talk about Citigroup for a minute, because that announcement that they had made yesterday, this global campaign to really shrink the layers of management across the world, how is that going to change the texture of the bank, and how is the news kind of sinking in among staff?
So, in fact, this is the biggest revamp at Citi in about 2 decades. What Jane Fraser's trying to do effectively is reverse a years-long slump in the stock price. So the bank will now operate 5 major businesses. 3 regional chiefs will be eliminated. They were overseeing about 160 different countries. So it's really a big reform that we're talking about here. There are pros and cons to what's happening. Mike Mayo, he's an analyst at Wells Fargo. He was telling clients that this will reduce fiefdoms, which have plagued Citigroup in the past. In fact, its staff numbers have ballooned to around 240,000, which seems like an incredible number. At the same time, Mike Mayo warned this kind of thing can cause unanticipated exits, the departures of people that you'd rather would stay, and there's a risk of it causing internal strife. So I think we'll just have to see, we'll have to keep watching, see, is it going to turn into a bloodbath? Will it all proceed smoothly and lead to the reform that Jane Fraser would so like to see?
Our thanks to Bloomberg's Will Shaw. Now, sticking with banking, UBS is planning to move its investment banking and trading operations to Credit Suisse's New York offices as the Swiss banking giant continues to integrate its former rival. Now, Danny, the reason I bring this up is this is the iconic 11 Madison building in Flatiron, Manhattan, very trendy, and also with the comeback to people in New York. It will be interesting to see investment bankers both at Credit Suisse and UBS flooding that building while the wealth managers hang out over on 6th Avenue.
I was going to say, isn't that 6th Avenue office like kind of close to Times Square? It's been a while since I've lived in New York, so I feel like my New York geography is kind of off. But yeah, I would take Flatiron over 6th Ave, I think, any day. I don't know.
You have a very large difference, let's say, in eating locations, in restaurant choices. I would say they're a little better by 11 Madison, but you know.
Yeah, get a little bit more trendy, move downtown. It's great.
Exactly.
All right, coming up, we're going to talk about that ECB rate decision. It's coming up in a couple of hours. We'll push ahead to that with DZ Bank's Sonja Marten. And Berenberg Senior Economist Kallum Pickering will be joining us later this hour. Does he see a hike or a hold? This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Sonali Basak is in New York. So we have, 7 of the 10 major currencies, their central banks are going to be having rate decisions over the next week or so. Today, it is the turn of the ECB. But a lot of what this brings into question is what happens with the dollar next. There's been a lot of calls for the demise of the dollar, be it because of Asia currencies, maybe another ECB rate hike. Let me just take you through what the dollar's been doing. I have, for our radio listening audience, a chart of the Bloomberg dollar spot alongside its 20-day moving average. We've been solidly below that for most of the year. Now, only just recently in August did we get this pickup above the 200-day moving average. But if you look all the way over here in the last part of my chart, it does seem to be turning ever so slightly. So has the momentum of the dollar run out of steam? Are central banks around the globe going to take the gains of the greenback and undo them? Let's get now to Sonja Marten, head of currency and monetary policy research at DZ Bank. Sonja, the dollar, can the rally continue?
No, I think, we've seen a fairly big correction. If you look at euro dollar, just in, June, July, we were trading around 111. Now we're down 107 in that area. So we have seen a sizable correction. The dollar has really benefited during this time from the increasing optimism on the US economy. People have become almost euphoric. It wasn't just the pricing out of the recession. It was a pricing in almost of a very optimistic outlook, which I believe is overdone. And as a result of that, I don't really see the dollar gaining more ground here. I think we've probably reached the end of that correction, and looking in the sort of towards the end of the year, I would expect the dollar to be weaker and for euro dollar to trade higher again.
Well, what is the risk that that goes the other way, that correction continues pretty meaningfully?
Well, the biggest risk, factor is, of course, the fundamental development at this point. If the US were to continue to surprise on the upside, and it would take quite a lot to achieve that. But if the US economy were to prove even more resilient than what people are pricing in right now, if the labor market doesn't soften, that could of course change the narrative. And conversely, if you look at Europe, we are in very weak economic territory right now, and we'd need, I think, some significant downside surprises, even from current already low levels, for the euro to continue to decline. So it's a risk scenario. It's not one I necessarily share.
How does 2024 play out? Because on one hand, we are talking so much about the rate decision today. On the other hand, you're seeing this divergence really start to emerge among monetary policies between the U.S. and Europe and across the world. So how does that play out into next year?
Yeah, I've said on these programs before, I don't quite understand why we are so obsessed with this last rate hike, come or not. If the ECB hikes or not today, is not going to materially change the outlook for the European economy, and it's certainly not going to impact the price I pay at the gas station when I go there next week, or in 3 months for that matter. The focus should really be shifting towards next year, and we're going to see quite a big divergence next year because, we do expect the Fed to cut rates by the middle of the year. Sometime in the summer, we're probably going to see the first rate cut. They have hiked very aggressively. They tend to then start cutting fairly quickly. And once they start, they usually deliver, continuous rate cuts. And when you look at Europe, it's a bit different because in Europe, we have the ECB, which is likely to remain very restrictive throughout most of that year. So we're expecting rate cuts from the ECB at the end of the year. And that divergence should allow euro dollar as well to move higher throughout next year. Although, given the economic fundamentals in Europe, I'm not going to be too optimistic. We have a 112 euro dollar forecast, which, really isn't particularly aggressive.
Yeah, because even if you look at what's happened month to date so far, Sonja, where we've got that pricing coming of a hike today, the euro is actually weakened so far in September. Yeah. So you say the hike today, if there is one, it's not going to make that much of a difference, which I totally agree with if we've already had 425 basis points of hikes from the ECB. But is there anything they could say today that would lead to a sustained strength for the euro, or is it all about what happens next year?
Well, unfortunately, I think part of the problem today is going to be that once the meeting is behind us, and that may generate some volatility intraday, we're going to start talking about the Fed next week. So, we're sort of moving from one event to the next, and there's a lot of uncertainty in the market. Could the ECB do something today? Well, I think if they were to be very hawkish in the statement, plus a rate hike, and potentially signal that there might be more in the pipeline, that could change the narrative in terms of euro dollar, and we could see the euro moving higher on the back of that. I don't necessarily think that's going to happen. I think the more likely scenarios, in fact, I do believe they're not going to hike rates because they don't need to. I believe they have so much in the pipeline, and they could adjust forward guidance on their reinvestments under PEP. That's a hawkish signal. So I think it's going to be a very hawkish signal, but I think they would have to deliver both words and action in order for the euro to benefit today lastingly from this meeting.
Sonja, what are the chances that the demise of the dollar strength comes from Japan?
Well, obviously, a lot of people have been discussing this issue. What happens in Japan if monetary policy changes in Japan, then yields in Japan will rise, and that's going to trigger some sort of, repatriation of capital out of the U.S. back to Japan. The story is not completely without its merit. Obviously, we all know Japanese investors are massive holders of U.S. treasuries, and there is a risk that there'll be some repatriation. Having said that, when you look at the yield differential, even if the yields in Japan do rise, they're still going going to remain well below what you get paid elsewhere. And if you look at the US, once the curve begins to normalize next year, hedging costs for Japanese investors in the US are going to normalize as well, and it'll still be attractive. I mean, there might be some drain, but I don't think it's going to be as massive and as detrimental to the US dollar as some people have sort of suggested that it might be.
Hey, Sonja, we got to leave, but quickly, before we let you go, because we got to ask everyone today, hike or hold, what does the ECB do today?
Hold.
All right, love it. Sonja, final word there. Sonja Marten of DC Bank going with a hold. All right, coming up, a growing chorus of supply warnings push oil to a 10-month high. More on that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. To hike or to hold? It's decision day at the ECB, and Bloomberg is live in Frankfurt as the cliffhanger looms. And a NASDAQ debut for the largest listing of the year. ARM priced its IPO at the top end of the range, and now the stock starts trading today. And more drama. Over at Goldman Sachs, the bank abruptly fires executives at a unit it's been working hard to grow. I'm Sonali Basak in New York with Danny Berger over in London. Danny, tell us about the European markets today.
Well, why would you move? Why would you put any risk on? Why would you bet on the euro or the dollar versus the euro at a moment when we're just 3 hours, less than 3 hours now, away from an ECB decision where the market pricing has moved a whole heck of a lot? Last week, 25% chance that they would hike. Today, it's about 60% chance. At the moment, we're looking at a euro, though, that is little moved on that change in pricing. Sonja Marten from DZ Bank said that she expects the euro to go to 112, but not until next year. So we're not moving much there, not moving much on yields either. Front end of the curve in Germany, just ever so slightly lower, but again, not a lot of movement. When it comes to European stocks, we are seeing action here, higher by about 1/3 of 1%. But Sonali, that's really just about the energy complex. Oil is moving higher, some of the metals are moving higher, so the best performing sectors there are energy and basic materials. How's the U.S. session shaping up?
You know how before, about a half an hour ago, I told you it was a beautiful day for an IPO to open here in the United States. It's ever so slightly more beautiful. The S&P futures up now 0.3%, calm as ice when you're looking at the volatility on the day. The more volatility you've been seeing intraday is in that 2-year yield. However, even there, you're getting a slight bid in bonds. You're looking at a 497 handle. The Bloomberg Dollar Index finally cooling off just a little bit, not all that much, but it is about plateaued since the levels we saw last week, slightly lower. Brent crude, this is what is on the rise. WTI flirting also with 90. We are going to keep an eye on that because longer term, this is where your worries about inflation start to seep in further ahead of some key decisions we're hearing by central banks.
Right, and would a central bank reacting to that really just kind of be a gut punch, maybe not well thought out reaction? But it's the main event of today. It's the ECB's dilemma over to whether to deliver a 10th straight rate hike or pause. Now, the meeting will definitely be a cliffhanger. 34 economists surveyed by Bloomberg predict a hold, 32 see a hike, but the market is leaning towards a hike. Joining us now is Kallum Pickering, Senior Economist at Berenberg. Kallum, we got to start there. To be honest, a beer in my life, whether I pay for one or get a free one, rests on the ECB hike today. So really big stakes for me. Do they hike or hold?
It's always good to get a free beer. It's going to be a close decision today. I think the market will know today what the top 4 rate is. If they hike, I think they're done. If they don't hike, I think the market will understand why. They can say we've downgraded our forecast. We've got lots of lagged impact of past monetary policy hikes to feed through. The manufacturing data are awful, the construction data are awful, and services is turning down. And so I don't think the market will worry that the ECB is leaving monetary policy too easy. So today I think we find out a lot of information, and market prices, I think at the end of the day, will reflect what is likely to be the realistic scenario then for the next 6 months.
Yeah, I'm going to be honest, it sounds like you're leaning slightly towards a hold, which worries me because that means I have to pay for someone's beer. So I'll send you the bill, Kallum.
We're leaning towards a hold on the basis that central banks do not want to cause policy-induced downturns.
But with this, though, it's only 25 basis points when they've already gone 425. Would this be a policy mistake, just another 25 basis points?
Monetary policy is already restrictive in the Eurozone, and the balance of data have surprised to the downside recently, which means you don't just have the 25 basis point to think about, you have the 25 basis points in context of economic data which may be worse. And what we've actually not seen yet across any parts of the advanced world is through this interest rate cycle, the phenomena of a panic about interest rates. And quite often what you see is towards the later part of interest rate cycles, people then start to panic. The other thing I would just keep in mind is central banks habitually cause recessions by tightening too much. So that's the question that markets should be asking now. Are we tightening into an unnecessary recession? And in hindsight, it's obvious, well, central banks went too far. At the moment, for the most part, when central banks are raising towards the end of the cycle, markets think it's okay, they think it's justified, and so you sleepwalk into these policy accidents, and I think that's where the ECB will be very conscientious of today.
Well, if you're talking about sleepwalking into a policy accident, then what does it mean in terms of, let's scenario plan for a minute here. Should they hike again? What does that mean in terms of the read-through to the economy and tightening financial conditions?
Of course, with every additional hike, you put more downward pressure on demand at this point. If the ECB stop now, or go one further, to Danny's point, I don't think that is a serious policy mistake. We may find that we fall into a technical recession over the course of winter. What makes me a little bit nervous heading into the second part of the year, with core inflation still too high relative to targets almost everywhere, is if the oil price starts to creep higher, if it gets to a big number, if we get a bit of a spike on gas, and then CPI data start to come in stronger than expected. We already had a bit of that in the US. Then central banks and markets might think, ouch, we need to go a little bit further. And so you can see a pathway into a policy accident. I don't think a hike today would be that policy accident, let's be clear.
So speaking of oil, I'm glad you brought us there, because how much of the shock in oil prices, how much does that pose a threat to what the ECB is trying to accomplish longer term?
So if I were a policymaker at the ECB, I would try to say to markets, monetary policy today is restrictive. And as a result, any supply-related surge in the oil price would be something that we should be able to look through. Because the problem that we had last year was we focused too much on the fact that CPI was close to target when the gas price went up, but didn't recognize that monetary policy was too accommodative. Now, of course, that would implicitly mean that the central banks would have to admit that they're partly responsible for the inflation surge, which they are. But that, for me, would be the way to go about it. Remember what happened with the Bank of England, though, in spring, when the market started to see a couple of CPI prints that were too high, money markets go up, and Bank of England says, ouch, we have a credibility issue here, we better follow the market. So the setup here is fairly dangerous for central banks. They have to be very, very clear about where they think monetary policy will be, how they might react in terms of these surprises, and what that might mean for inflation next year.
Could we get a hawkish QT surprise from the ECB? Is that out of the question?
I think that's unlikely.
Okay.
I think the bond market is skittish, it's tired, it's been a long year. The market already knows that central banks are not afraid to cause recessions if they need to. Roughly speaking, inflation expectations, interest rates are well anchored. So surprising with a QT announcement, it's probably a little bit too early. It's probably different for the Bank of England at the next meeting because they've already forewarned markets. And remember, the thing with QT is it's all about not surprising. They want this to happen in the background, not as a policy tightening. And I've been saying for a while now, we should be calling this quantitative reversal, not quantitative tightening, because there's no intended tightening here. There's no surprise, and it's small scale.
The problem is QR is taken by a QR code, so we can't use that one, Kallum. Otherwise, it's perfect.
There you go. Barcode monetary policy.
Yeah, I mean, sure, why not? Look, to kind of zoom things out and look at the globe and perhaps even the U.S. a little bit, this whole idea of, the last leg of the mile from getting from, 3 to 2%, that being the most difficult part, was really taken by comments from the Walmart CEO yesterday, who said that there's been a bit of rebalancing as it relates to higher wages in the country and that inflation and higher prices are kind of with us. Do you think that narrative is going to take more of a hold, that narrative is the right one, rather, that maybe we shouldn't be talking about going down to 2%? I know that this has been started to debate more, but if you have the Walmart CEO now starting to incorporate that into his language, is that threat more real?
I think that's a realistic scenario. I think we've gone from a world where after the global financial crisis, central banks targeted 2%, but were happy with anything above 1%. Now we're in a world where we target 2% and we're happy with anything below 3%. And I think The danger here is if you decide we just need to get to 2% and you cause needless recessions, you put the economy back to sleep, you get back into that sluggish funk of low interest rates, low inflation. I think that's the last thing that the US and the Western world needs, and I think policymakers actually know this. And so I think we'll stop, we'll see where we get to next year, and then we can adjust. If we're at 3% inflation with no recession, that's a good outcome from where we've been.
Berenberg's Kallum Pickering, thank you very much for your time. Now stay with Bloomberg for full coverage of the ECB decision due at 8:15 a.m. Eastern Time. And up next, we're tracking ARM ahead of its NASDAQ trading debut later today. This is Bloomberg.
If you do care about fundamentals and you've got a fiduciary duty to manage risk, this stock's just really too expensive. So is NVIDIA, so is Tesla. Does that mean it won't stop going up? Maybe not. Are we closer to the end of this sort of hype bull cycle than we are to the beginning? I would expect so. Can I tell you exactly when the music's going to stop? No. But I do think it's helpful to let investors understand the level of fundamental risk they are taking in buying an IPO at this price.
That was David Traynor of New Constructs. And based on his own discounted cash flows, he believes that even if ARM increased its profit by 10 times, it would still be too expensive at the price it's being given by public market investors. But here's the thing. There have only been a handful of IPOs this year, and companies with ties to the booming industry of artificial intelligence, they're getting higher multiples. ARM prices its IPO at the high end of its targeted range and starts trading today. Joining us now is Matt Bloxham of Bloomberg Intelligence and Bloomberg Television's Tom McKenzie. Matt, it's interesting when the bankers were trying to price this, Masayoshi-san of SoftBank had said that he wanted to do $51 a share instead of the potential $52 a share to ensure a smooth debut today. But how much of this is a matter of valuation, Matt?
Well, I mean, clearly valuation is incredibly important to people, and really ARM does have to grow into that valuation. They've set out a kind of very clear story that's kind of, essentially ARM is the foundation of everything to do with technology. It's at the core of pretty much every kind of processor out there, and they have this huge addressable market. I think it's roughly about 100 times earnings if you look at the historical reported numbers. So they need to grow sales and profits quite substantially to kind of bring that multiple down. That's clearly what investors are believing that they can do.
Tom, does this tell us anything how this IPO goes today about appetite in general about chips, or is this just an IPO story? What does this tell us about the broader environment?
It certainly will tell us something about the appetite around artificial intelligence and whether or not, and there's some big ifs, and Matt has all the details on this, but in terms of if they can actually transition away from their dependence on smartphones, and we know that that is a sector that remains soft. It's going to be interesting to see how much uptake there is for the iPhone 15. But if they can actually transition away from smartphones towards the data centers that Rene Haas, the CEO of ARM, keeps talking about, and of course those AI chips. But we know, we've talked about the fact that they're central to their business right now are CPUs, not the GPUs, the chips that NVIDIA is so important in, and whether they can play some catch up there. So yes, it will give us a sense in terms of the appetite of artificial intelligence, but clearly and crucially, whether or not investors are really betting that ARM can make that shift, and in what kind of time frame.
Matt, how likely does it seem that they could make a shift like that?
Well, I mean, I think when you look at the business and certainly what they're doing, and the kind of the rhetoric, like NVIDIA wanted to buy this company. NVIDIA's at the centre of the kind of whole AI transition. So I guess clearly NVIDIA sees ARM core to its future. So I think that's an encouraging sign. But yeah, it is a double if. Can ARM make that transition away from smartphones? Can the AI momentum that we're seeing today continue beyond the short term? Two big ifs. But I guess investors like a kind of fairly clear story that they can understand. Even if there are question marks around it, it's a very clear story, and that's what they're buying into.
How much are the risks, Tom, tied to China relevant to the story here? When you look at the macro picture, the thing that underwriters can't control is what happens after today. But really what happens after today is the whole story.
So, I mean, to Matt's point and the broader part of this discussion, look, there's no question that this is a significant and impressive business, but it's all, as you said in the lead up to this, around the valuation. And the China component is really important. They do have this China unit, and what came out in the prospectus within multiple pages and paragraph after paragraph talking about the potential China risk and the fact that they have far less control over that China unit than many had expected. And of course, many of their designs in terms of the software and the architecture is used in terms of the design of chips that goes into chips, whether it's in the auto sector or into the smartphones that are used in China. There are the sanctions in place, of course, that really consequential move towards the end of last year by the White House to really restrict the use of chips and US technology. So they're vulnerable on that front as well. And China is going to be key in terms of gauging the risks for ARM longer term.
Now, the reality of the situation is SoftBank is only floating a part here of the ARM existing stock. Matt, if you think about SoftBank's ownership and governance, on one hand, their control over the company can be seen as both a positive and a negative. How do you see it?
Yeah, I think it's certainly a question mark. I guess, the general expectation would be that SoftBank's going to sell down more shares over time, looking to kind of, I guess, ideally monetize a higher value for the business. I think SoftBank, the good thing about SoftBank for investors is they're a very well-known entity. It's obviously been a bit of an up and down time for them in recent years, and perhaps the kind of vision fund hasn't played out the way they would have liked to. But I think historically, Masa-san has a very good track record with investors. He's kind of well understood, and the business is well understood. And I think that's important. So people will kind of feel they've got a good idea of what they think SoftBank is and how they'll behave as an owner of ARM.
Well, this is the fact I got that I pulled from the Bloomberg story. It's selling about 10% of shares, and on average, companies IPOing in the U.S. float 29%. I mean, it is a really tiny float, to go back to Shonali's point. Tom, I mean, isn't this all just going to be passive money or money following passive indices, just having to buy ARM and chasing just really small shares?
So that may be a part of it, and we'll see whether it ends up in the S&P 500. But it does give, obviously, Masayoshi-san the optionality to come back and put more shares out on the market, doesn't it? But you're right, 10% is relatively small. There's a really intriguing component around the banks that are partner, of course. They've got a huge number of banks involved in this deal. And the loans that are tied up, the margin loans, that are tied up to Masayoshi-san and SoftBank and that relationship. So that's an intriguing component as well. So, yes, we'll see to what extent that causes any concern at all. That relationship and those relationships are really important. And also just worth flagging, let's remember as well, more broadly for this IPO, you do have the backing now, the buy-in from Intel, TSMC, NVIDIA. That is going to give some confidence to investors as well.
Big day for ARM, big day for SoftBank, big day for Mizuho, Goldman, and all those underwriters. Our thanks to Matt Bloxham and me, absolutely, but it's an easier day for me, I would say. Coming up next, we're going to talk about the deadline for the United Auto Workers strike against GM, Ford, and Stellantis. It's set for tonight, and we'll have the latest on that standoff next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Shonali Bassick in New York. All right, a quick look at what's ahead today. You know it. We've talked about it. The ECB rate decision, that will be at 8:15 a.m. Eastern time. Then President Lagarde's remarks hit at 8:45. Then U.S. PPI, retail sales, and jobless claims. All of those will come at 8:30 a.m. And then, of course, SoftBank's ARM will begin trading on the NASDAQ when the market opens. Shonali.
We're also keeping an eye on auto union talks as the strike deadline looms. UAW president says the union and major Detroit automakers are still far apart on a new labor contract. The Mercedes head of North America discussed the industry-wide implications.
We're not directly affected from a potential strike, which we wish it does not take place, as our two factories are not under UAW. But obviously, any disruption and any issue will have will give some shocking waves out to the whole industry.
Joining us now is Bloomberg's Craig Trudell, who has been following this story very closely. Craig, what are the tensions that are appearing so close to this deadline?
Yeah, it's kind of take your pick, right? Where I think we have a situation where these companies are in very strong position. Let's start with the good news that, all three of these companies are in a pretty healthy spot in terms of, making money and actually paying out, pretty substantial profit sharing to employees. I think on the part of employees, I think there are a lot of concerns about whether pay has kept up with the amount of increase in earnings that we've seen from these companies the last few years. Concerns about the transition to EVs and batteries and whether or not union members are going to be brought along in that transition, and all manner of issues in terms of inflation. Whether or not battery workers will be represented by unions. So, there's a host of issues here that are, that go beyond just the auto industry that are really, significant to, the broader U.S. economy.
Another EV story we've been tracking. Yesterday, the European Commission President Ursula von der Leyen announced a probe into Chinese EVs and potentially non-competitive practices there. We heard from Chinese officials today. I mean, unsurprisingly, they're unhappy with it. But what exactly were they saying in I guess, response to this? Yeah,
I think they're pushing back against the idea that China is doing anything, special here or different from what the rest of the world is doing. And they, of course, have a point in that respect that, the whole world is trying to kind of help, usher in this new era of electric vehicles. And to do so, you need to support the car companies. You need to support a battery supply chain being started. I do think that when we sort of, think back to what's happened and how China has sort of gotten to the position it has, for decades, it was requiring international companies to come in and set up joint ventures. We haven't seen, the rest of the world take that approach. It did sort of give preferential treatment to its, battery suppliers that helped, make CATL the dominant force that it is today. So are there specific things to China's industry that sort of, have helped them, become so dominant? Absolutely. But they do have some grounds here to play, this game of whataboutism.
Right. Our thanks to Bloomberg's Craig Trudell. Now, a look at some of the stocks we're watching in pre-market trading in the United States. The automakers are trading very mixed today. UAW prepares that strike, and deal talks are dragging on those stocks sometimes. Ford says it's continuing to put 100% into reaching an agreement with UAW. You are watching Stellantis down about 0.2%. Ford up slightly on the day, and General Motors up 0.4%. We're also taking a look at the airline stocks because American and Delta shares are finally up. They had slumped quite significantly, the most in 2 months, after American cut its third quarter forecast in part because of a jump in jet fuel prices. A lot on the transportation front there, Danny, a lot on the infrastructure, a lot tied to oil, and a lot tied to labor. So these cross currents of the economy certainly shaking up.
And look, the airline story I like because, again, it goes to this argument that I mentioned from Cudmore that higher oil prices, higher fuel prices in general don't necessarily mean higher inflation. If airlines don't have pricing power anymore, as they reported, fuel actually translated into lower growth and lower revenue for them.
It's not even winter yet. Let's see how long this all drags on for. That does it for Early Edition. Surveillance is up next. Stay with us for full coverage of the ECB decision due very soon. This is Bloomberg.